What if I told you I had a strategy that has a 100% success rate? Would you be interested? Of course you would. Well, stick around because in this video, I'm going to show you exactly how to implement it into your portfolio. Hey guys, Corey here. Welcome to the channel. If you guys are stopping in for the first time, be sure to subscribe and tap the bell, of course. This way you know when I post new content that's epic, just like this, right? And of course, if you really want to be generous and you care about my feelings, you could give me a thumbs up. It's greatly appreciated. This strategy is very successful. I have implemented it in my portfolio for several years. I haven't lost on this strategy once. It is very powerful, but a little complex. So strap in. This is going to be a barn burner. I'm going to show you exactly how to set it up. Like I said, it's a little complex, but you're going to love it. Once you run it the right way, you're going to start printing cash all over the place. And we all like cash, right? Lots of cash is good. But what if I said we could print cash every time we do it? Would you be interested? That's what we're going to do right now. If you guys enjoy this strategy that I'm going to show you that you're implementing into your portfolio and you want to learn more of these strategies, or maybe you don't quite understand it, you're a beginner and you're trying to grow your financial freedom, I told myself that when I achieved financial freedom, I would do everything I could to help everyone else out. I achieved financial freedom. I can buy the cars that I want, houses. I can also buy things for my kids like dirt bikes. I can buy dirt bikes for myself. We can go on vacations, and I really love cars, so I get to buy a new car or two or three every year, and I absolutely love it, enjoy it. However, I told myself that I would help others achieve the same financial freedom. So if you guys are interested in achieving your financial freedom that you ultimately deserve, I would love to help you. You can sign up for one-on-one coaching, full Discord, and training course at any time right there on the screen, investwithcorey.com, or in the information box below. I just launched another masterclass boot camp. It's going to be the last one for a while. 3 spots remain. So if you guys are interested, you can also sign up for that as well. I look forward to helping you on your financial journey. If you guys love my alerts on YouTube, you got to understand how accurate and how many of these alerts are going into the Discord. For example, I told everyone to DCA and add Affirm and W, which is Wayfair. Wayfair was at $48. Look right here. And everybody was worried about that. And I told everybody Wayfair was going to run. Well, let's take a look at my Wayfair position and I will show you guys I am up $1,000 on Wayfair. I got it at $50 in this portfolio, $49 in the other portfolio, and it's over $53 and is going to run. And if that's not enough for you, let's go ahead and look at my prediction. I drew a line last weekend and look at the line. Wayfair is literally following my line that I drew last week all the way up and consolidating. It's going to come down. It's going to run on earnings like crazy. This is just one of the many. Also in my Discord, I told everybody to buy puts on Ford, and I'll show you exactly what I'm talking about. Here we go. I love Ford, but I bought puts to hedge. F is tanking, Ford going down. Anyone who has puts is likely to print. I told everyone Ford was going to drop right here. 7:24 at 3:40 p.m., 20 minutes before earnings. I said I love Ford, but I bought puts. We're going to go over here. I'm going to show you guys what I did on Ford. I'm going to scroll down on Ford and here you'll see it. There we go. At 3:33, before I even put the alert out, I bought 4 puts for $11 and sold them for $3.68, making great profits in this small challenge account. In my big account, I made over $500 or almost $500, and I'll show you right here. Screenshot of profits. Here is my return on Ford in my Webull account. Made almost $1,000 on Ford in basically 15 minutes. It was overnight, but the drop happened in 15 minutes. There's a lot of profits going on here in my Discord. You can see that right here. Jesse sold all of his SoFi, several thousand shares, 2,000 shares at $7.79. His entry was $6.39. So he made $2,000 profit in a matter of a week just on these shares off of my alerts. There is a lot of these alerts going on. Took 20% profits, $500, and this was on Palantir in just a few days. I have a lot of students that are up. Jesse is up 27%, $7,000 in a few weeks. I have Sherry, who's also up like 21%. If you guys also want to check my website, investwithcorey.com, you can check out the testimonials there. If you guys want to sign up at any time so I can help you with the alerts, the coaching, the trading, and you guys can be a part of the Discord, I would love to help you grow your financial wealth. This strategy is very powerful. It takes advantage of earnings, IV crush, but not only that, I'm going to show you how to hedge your position. So what we're going to do is we're going to take advantage of earnings calls on certain stocks. And for this specific video, considering earnings is coming up on Starbucks, we're going to implement this strategy on Starbucks right now. Let me show you how you can set this up in your portfolio and start printing lots of cash with no downside, because the way I hedge the risk in this strategy, it is absolutely beautiful. First things first, we are going to look at the Starbucks chart to see where we are at. And it's looking like the stock price could drop Monday morning to maybe $73. But just for the example of this video, we're going to say the stock price Monday morning opens up and we're at 74.05 or 74 flat. We're just going to say 74 to keep it simple. What we're going to do is we are going to go over to our brokerage and we're going to buy 100 shares. I have already queued 100 shares for Monday morning. You guys can see right here. We're going to buy 100 shares. Now, you might be saying, okay, that's great, but what if the stock goes down? Well, I've got just the plan for you. What we're going to do is we're going to wait for the opening bell. We're actually going to fill this order before the opening bell if we can help it. This way, by the end of day Monday, I expect the stock price to relatively be around $75, give or take. What we are going to do, even if this doesn't happen, is we're going to go into Starbucks options and we're going to buy a put for August 2nd, which is next week. If the stock price goes up to 75, then the 74 put is going to be a little bit cheaper. We also have the weekend of theta decay kicking in, and theta is $21 a day. So come Monday, this contract's going to be worth about $250. And if the stock price goes up to 75, then this will also go down roughly about 60. So this will be worth around $200. So I'm hoping the stock price goes to 75, but if it doesn't, then it's going to be $250. So what we'll do is if the stock price doesn't go to 75, then we will just buy the $73 put. If it goes to 75, we'll buy the 74. So for this example, let's say the stock price goes to 75. Well, then this will be roughly 200 to 220 near the end of the day Monday. We will buy this put. Once we buy this put, this gives us the right to sell the shares on Starbucks if the stock price, say, drops to $50. However, we won't do that. Let's say after we buy this put and the shares, the stock price drops to $50. Well, the intrinsic value of this option is the difference between the in-the-money strike price versus the stock price. Since this is a 74 put and the stock goes to, let's say, $50, then this put would be worth $24 per share, $2,400, because that's the difference between the strike of the put and the stock, plus the extrinsic value of the 3 remaining days. So this put would essentially be worth about $2,500. So let's get out our calculator, and what we would do is we would then sell the put for $2,500 minus the $220 we paid for it, roughly leaving us with $2,280. So almost $2,300. We bought the shares at $7,400, okay? $7,400 minus $5,000, because the stock price dropped to $50, we lost $2,400. However, we minus the $2,280 that we've gained from the put after the cost of the put, we only lost $120, which means now we don't have to sell the shares. We can just keep them because we're only out $100. Then what we would do is we would sell a 55 call going 2 weeks out to collect $75. We do that again another 2 weeks, collect another $75. We're now above our cost average. And if the stock runs to 55 and we get assigned, we now make $500 plus the $150 on the calls. We made $650 exiting at 55 because we bought the put. Now, there is another way to run this strategy. Besides just buying the shares and buying the put, you can also sell a covered call, because what this will ultimately do is pay or finance the cost of the put. However, there is one other scenario we have to talk about before we get into that. You buy the shares for 74, the stock goes up to 75 by the end of day Monday, you buy the 74 put, stock plummets to $50, you get your extrinsic and intrinsic value back by selling the put, you keep the shares, you're only out $100, you sell covered calls and you exit at a profit. But what happens if the stock price goes up? Well, if the stock price goes to $80, you just made $600 on the shares. The put cost you $220. It's probably still worth $20, so you lost $200, but you gained $600, so you made $400. Again, it's a win. Both scenarios are a win. What happens if the stock price goes up to 76 or 77, comes back down to 76? Well, then the put is still got half of its value or more, so you're only out roughly $80 on the put, but you're now up 100 or 200 on the stock, so you still make $100 or keep the shares and keep selling covered calls. Again, you're still in the profit. Now, let's go on to the next scenario. You buy the shares at 74. Stock price goes to 75. You buy the 74 put for 200. Exact same scenario. However, next, we're going to click on sell call go out to August 2nd. The put cost us $200. We, at this point, will sell the $78 call. The $78 call will be worth roughly what the $77 call is right now because the price is $74. We're going to go up $3. Once the stock price goes to $75, we buy the put, then we sell the call, which is a $3 spread. So we're going to go up to $77. That's $160. We're going to sell that. That means the put only cost us about $40 to $60. So what happens in that scenario? Well, if the stock decides to go all the way up here to $80, well, we're going to get assigned on the $78 call. So what we're going to do is we're immediately going to close the put Wednesday morning, which means we're going to lose almost all of it. We're only going to recoup maybe $20 at the most. So we lose $180, but we collected $160 on the call. That means the put only cost us $20. Now, when the stock gets assigned on our short call at 78, we collect $78 or $7,800. So let's look at the calculator. We buy the shares for $7,400. We buy the put for $200. Then we sell the covered call for $160. Then we end up getting $20 more for the put because that's what it'll be worth with 3 days extrinsic value. We'll even say $10. So we're still out $7,430. Well, then we take away the $7,800 we get collecting on the assignment. We made $370. Now, on the other side of things, if the stock drops to $50, we buy the short call back for $1. So we buy the shares, $7,400. Then we buy the put for $200, $7,600. Then we minus $160 for the short call. So our average cost right now with the put is $74.40. The stock drops to $50, leaving us with roughly an extrinsic value of about $100, maybe a little less, and an intrinsic of $2,400. So what we do at this point is we take away $2,500 for the put value, leaving us with an average price of $49.40, but the stock fell to $50. So we're still up $60. Now we sell a covered call 2 weeks out, let's say $52 even, and collect $120. We take $120 away, and then we get assigned at $52. Take away $5,200, we make $380. Now, you can see in this scenario, we make about $300 to $400, give or take, no matter what happens. We've covered our upside and downside. The worst case scenario, the stock drops, and we got to wait by selling the put. We're at break even. We sell a covered call for a couple of weeks and then get out. But no matter what, we break even, wait a few more weeks with covered calls to make a profit, or the stock goes up and after paying back the cost of the put, financing it with a covered call and getting assigned, we make profit. But in this situation, it's 100% success rate. We can't lose. And even in the situation where we do lose slightly, it's only going to come if the stock drops and the extrinsic value decays out completely. So for example, we spend $7,400 on the stock, we add $220 for the put, then we sell the covered call for $160. Our cost is $74.60. Stock drops to $50. Let's say the extrinsic value of the contract is only $20. Well, there's $2,400 difference between 50 and 74 plus $20. Well, we minus $2,420, giving us an average price of $50.40. We're only out 40 cents a share, which is $40. So we're in the negative $40. Well, we sell a covered call going 2 weeks out for $120 at $52, and now we're $80 in the positive. The stock drops, we sell a few more covered calls, and we're still going to get out. It's 100% success rate, and that's the worst case scenario. Best case scenario, the stock runs, and we make the $300-400 on the assignment, and selling the short call leverages and finances the put, which also hedges our position on the downside. If we don't sell the covered call, we just buy the shares and the put, we're at $76.20. If the stock goes to $80, we made $600. So we take away $8,000. We are up $380 after a complete loss of the put. However, Wednesday morning, the put's still going to be worth $10 or $20. So realistically, again, $400 profit. This is the ultimate success 100% win ratio. Buy the shares at 74, buy the 74 put, then wait for the stock price to go up on Monday a little bit so you can sell the $77, $78, or $79 call, preferably $78 or $79. Then you're completely hedged. You can also leave it wide open if you believe the stock is going to go up. However, if the stock ends up going down, it is significantly better to sell the short position call. The reason, if the stock goes all the way down, you got to sell the put, and it's much better to have a decaying short call option that gets you another $160 credit, pretty much make the put for free. So if you think the stock has a better chance of maybe going down, but you want to take the risk, buy the shares, buy the put, sell the call. If you're almost sure it's going to go up, buy the shares and buy the put. put. This way you're hedging your downside. If you end up buying the shares because you think it's going to go up and you don't buy the put and it ends up dropping, you're going to lose a lot of money. So it caps your upside to only being able to make $300 to $500. But if you can do this on every 100 shares, you're making $300 to $500 on every 100 shares, and it's all but guaranteed. I would say this is literally like 98 or 99% success rate. Worst case, you're out $50 or pretty close to break even, like I said, and you just got to sell covered calls a few weeks out, even at $50. And after a couple of weeks of covered calls, you are going to be at break even or in the profit. Then once you get assigned, you're up a couple of $100 on the assignment. Let's go over this right quick on the whiteboard. We are going to buy the shares for $7,400. We are going to buy the put contract, the $74 put, for $220. Giving us a total of $76.20. The stock plummets to $50 a share, which is $5,000 for 100 shares. We know this put is worth $2,400. The difference between 50 and 74 is $2,400, plus some extrinsic value, so about $2,500. So we sell that for $2,500. So our average cost is $76.20 minus $2,500, leaving us with an average price of $51.20. So worst case, we're out or $120. We sell a covered call for $120 to $150. So we'll sell a $52 call 2 weeks out, collect $150. We're now at break even. If we get assigned, we now made $200. If we do this another week, then we make even more money. We're now $350 in profit. Now, if the stock price was to go up to, let's say, $80, well, then that's $8,000 minus $76.20. And this is $380 profit plus maybe $10 left over on the put, which is $390. If we had have sold the $160 call option, which is the $78 strike right there, $78 strike, that would have given us another $160, meaning we wouldn't be out 120 down here. We would actually be in the positive 40. And if we got assigned the second week in, we wouldn't make $200. We would make closer to $320 to $350, actually $360. So you can see that on the downside, it's better to sell the covered call. However, if the price was to go up to 80, we would get assigned at $7,800, but our average cost would not be $76.20. It would actually be less because we collected money on the covered call. So it would be $74.60. 74 plus 220 minus 160 is $74.60. So then our cost would be $74.60, giving us a profit of $340. So if we sell the short call and it goes up, we make $340. And if the stock price goes down and we sell the short call, we're actually up $40, and then we can collect another $150 on a covered call and an assignment for $200, which puts us at $390. If we don't sell the covered call and it goes down, then we're only out $40, and we can just sell covered calls to make money going forward. So no matter what we do, we can't lose here. There's really no loss. Granted, the upside potential is capped, but if we're doing this on 5 contracts, then we're doing $2,000 per earnings. Of course, you would need about $35,000 worth of capital, but 35 grand to pretty much make a guaranteed 2 grand every earnings on every stock in that amount. So you guys can see how powerful this strategy truly is. Hedging your position with a put while buying shares, and then hedging it even further by selling a short call caps your upside, but completely eliminates your exposure, so you lose no money. The only downside is breaking even and having to sell covered calls to exit at the $50 mark. The exact same thing would happen if Starbucks went to $60. It would just be less value on the put and less of a loss in the shares, but the ratios are relative and would stay the same. This is a very powerful strategy. Like I said, it limits the upside, almost completely eliminates the downside. Thanks so much, guys, for being here. I appreciate you. Be sure to subscribe and tap the bell so you don't miss epic content like this. And of course, give me a thumbs up, as it greatly helps the channel grow. If you guys enjoy this strategy and you're having trouble in the market and you're looking to grow your portfolio, grow your financial freedom, and learn, but you're having a hard time, I take a lot of pride and put a lot of effort into helping everyone grow their portfolio. I want to help as many people as I can, and I would love to help you achieve your goals and the financial freedom you ultimately deserve. You guys can join my one-on-one coaching, Discord, and full training course at any time right there on the screen, investwithcorey.com, or in the information box below. All my students are making lots of money in my Discord. Everyone is learning, growing, and achieving their financial freedom, and they're all one step closer to it, and that could be you. This video is over, I know, but I picked out another video just for you, and you're going to love it. And that video is right here. Click it. You guys are going to love this video. And remember, until the next one, let's grow our wealth together. Take care, guys. You're still here? Click the video. I'm over there waiting for you. Didn't you know I'm in 2 places at once? Well, actually, I have 75 videos on this channel or more. I'm actually in 75 places at once. It's pretty good, right? Like a magician here. Well, actually, I'm a magician. Click the video.